we're gonna just cover 6 points. 5 things to clean up before you get to look for funding, and also cover basics. These are generally just fundamentals that you should actually have an understanding before you start and engaging on identifying the type of funding that you need in terms of the sources, and preparation for funding for all types, and what are the things that you need to consider during the application process, and the top 10 mistakes that entrepreneurs make on funding, and then we'll take it through the questions and answers. So before you begin the funding, there are basically 5 points that you need to just watch out for or clean up on. Make sure that you have an appropriate skill and qualification and experience based on what your core business is about. And if you do not, as a founder, have that expertise, make sure then your mentor or one of your team members has that industry requirement experience as a bare minimum. Understand also, though, as a leader, you are expected to somehow understand the language of business, which in this case is finance. And that is important because they're going to be asking you questions. And most of the time, you as a founder are the one who's presenting the business. Number 2, make sure that your business has access to market. Pay attention to the detail in relation to the distribution channel. Make sure you choose a distribution channel that allows you to have a shorter sales life cycle, but also it has sufficient volumes to make your break-even point. We have noticed, though, in the past 2-3 years that they're no longer really considering letter of intent because people have been forging letters of intent. So just make sure that whoever that you're approaching as a funder, they are accepting the letters of intent. But when you cannot, you must also just demonstrate your sales, the leads that you are actually receiving, but you aren't able to fulfill. Number 3, avoid having too many target customers in your customer profile. Rather choose one target market customer and then cross-sell and upsell instead of trying to choose a bigger broad. Try by all means to go rather very niche, but very big, very clear on how you will make sure that you increase, you are keeping a customer for a lifetime. Solve one problem, avoid you solving too many problems, because then what happens, you end up losing your story, but also the mark on what is your unique selling proposition. Focus on one stream of income. And this is also tying back into solving one problem. So that means you're going to need to relook at that business model, the revenue streams. And if it's a revenue streams that is many of them, make sure those revenue streams are coming from using one resource in terms of one skill. You don't need multi-skill to generate those revenues. So just try to focus on that so that you build a business that is really sustainable, but also it's matching with your expenditures. Last one, pay attention to the positioning, because your positioning basically determines your selling price and the placement of your product or service. Because then if your positioning is well done, it's gonna also be easier for you to find the right market. So this number 6 one is really tying back to the access to market. So assuming you've managed to get and panel beated yourself on that, then you're gonna need to get to the basic of funding. So when it comes to funding, you really have about 4 types of funding. In a traditional way, it's generally 2, which is going to be a debt and equity. But in South Africa and also in developing countries, and even also some countries like Europe that are developed, they subsidize certain sectors, especially like agriculture. So you will then have a grant funding. And then in South Africa, we're very lucky. We have alternative funding, which also include ESG programs. But I think even in other countries, there is crowdfunding, invoice financing, and also purchase order and contracting. So those are type of other source of fundings that are available to you. I will go a little bit deep on these as we move along. So when it comes to debt funding, you really have to think of it as you are borrowing money from someone and you're gonna need to pay back the capital plus interest. It's a good and a quick access to capital. However, definitely the only time you should really consider this type is when you have a security or a guarantee, and also your net income, which is your bottom line, is sufficient to cover the interest, and you can be able to pay capital. And that is then going to be linked to number 3, which is your asset must be above your liabilities in terms of solvency. You must also have passed a proof of concept, meaning you are already generating some income, but you are demonstrating that you cannot keep up with the orders. And the last one, you must be at a stage where you now want to scale. You have tested certain things, you're now going to scale. And that is usually within the South African context is roughly between 2 to 3 years. And if you are a slow learner like me, maybe 4 or 5 years, because yeah, I think I stayed too long in business school, and what they teach in business school is not the same as running your own business. So anyway, the equity funding really is focusing on you selling a portion of your ownership. I think also as South African entrepreneurs, we have a tendency of owning 100% of nothing. And that is very critical to keep aware that the higher the percentage you own of your business, it means then you're going to have to cop up a lot of share contribution. But the good benefit about this and the challenges it provides is that you may actually lose ownership, and you may also lose the decision making. But again, what's the point of owning something that is zero? So it's really kind of going to need to balance out based on your need. You can actually get this at the startup. You could be also at the proof of concept or even at the idea stage, but you're gonna need to have a very strong USP and a differentiator, so that it's very clear how you intend to own up a certain portion of the market share. And I think you should be open to negotiate, but also be open to say, you know what, when we hit this mark of units, I would like to convert this equity to be a debt later. So always put that maybe as part of your agreement with your equity partner. You must also be a person who's willing to work with others. And also you're gonna need to look at the investor that you're bringing in, what skill set and participation are they willing to do? Other investors, they will like to be involved, others they will not like to be involved. So you really need to be very clear about that on the onset. Pay attention also to the exit strategy as to when it's time to exit, how will it work out, what will be the valuation of the business be done, and on the basis of what. Let that to be discussed up front. Now, there are key points that you need just to be aware when it comes to equity funding. As I said earlier, ownership dilution might actually happen. You also have to align your goals to the investors one. Try to discuss things like for the next 10 years to 20 years, what are your goals? And because you want to build something that is sustainable, you want to build something that over time is going to actually generate a real serious value. It does take time because we are learning each other, we don't know each other, and there's also a lot of legal and financial constraint, a lot of due diligence also within that. Investors' expertise, I've already mentioned that, exit strategy already dealt with that. The legal and tax implication is very important. That has to be done at the transaction date when you're actually bringing the shareholder, the new investor in, but it's also going to have an impact at the exit, especially capital gains tax, plus also some transfer tax implication. So that you really need to get a professional guidance on. Be aware also of specific regulation, especially around equity funding and also around competition, because sometimes when there is an acquisition of another business, there is a possibility of anti-competitive arrangements that can actually crop in. Valuation, try to make sure that you do your valuation. You don't just thumb suck and say, okay, you're going to have 45%. 45% of what? What is the value? Make sure that your financial statements are clean and tight. And if there's things that need to be revised and reviewed, make sure that is done at the year end. So transparency also, be open when you're making up the assumptions about stuff, but also be transparent even in your records management. Investor relationship, focus on building the relationship and also set up parameters on how often are you going to be communicating with the investors. Build a long-term relationship, as I had said earlier. Now, grant, which is another item that, okay, I've just realized there's an error there. Okay, so under grant, you really have to focus that on understanding that majority of the grants will generally in South Africa come from the government and also provincial. We have seen though that DFIs also will actually distribute some sort of grants like NEF. Just make sure that when you are actually looking at applying for the grant, you tie back your problem solving to your social cause, job creation, poverty alleviation, education, but also include rural areas. That will then help you to get your application to be on top of the deck because you are touching to those pain points of the government. Make sure also that the funder is not necessarily just funding the NPCs, because there are funders that will look at the NPC. So make sure that if you are using a PTY LTD, that they do accept PTY LTD in terms as a social enterprise, if that's what you are also doing. But just make sure, guys, even if you are running a profit-making business, you can bring job creation and poverty alleviation and education, depending on the product or the problem that you are solving. Make sure also in your solution, you are dealing with the root cause. It has a strong M&E to demonstrate the impact and build a storyline and the stats on applying for that grant. The grants in South Africa are available across board, whether it's a profit-making business or a non-profit-making business. So other alternatives is crowdfunding. This one is generally also for ventures and projects where you are getting a lot of money or you're getting small little money from a lot of people, which then end up being a sizable. You can do it for both social cause and also for a P2I LTD. There's lots of platforms. I think there was an article under SME South Africa that was actually talking about this in detail. Invoicing or seeding or factoring of the debtors. This is very important because you don't need to get your money back from your debtors if they have not paid. If you actually have proper systems and processes in your records management from your terms of conditions, plus you are also making sure that you can use your debtors as a security or actually as outright cession. Merchant cash advances, this also can be based on agreed future credit or even a sales. Purchase orders, I think this is a big one, which when you get a contract or a purchase order, please just, you can then get a funding for that, but just make sure that your contract, your costing, and the bottom line of that project or that PO, you are making at least 25% net profit. Okay, now let's get to the planning of the funding. So the money that you actually is a debt is the borrowed money, and then the equity you are selling the ownership And then the source of capital really can also be generated internally by from your profits, but also you can raise funding from the credit, which is in this case the suppliers. Now, preparing for funding. Preparing for funding, it's a process. You gotta first need to identify what is the investment. What exactly are you gonna be using the money for? And you gotta need to understand whether it's gonna be a short term or a long term. And in general, a short term is regarded as something that can be even from 3 months up to 12 to 24 months. And then post that, then everything else is considered a long term. In accounting terms, a short term is less than 12 months, but in the funding space, they do consider up to 18 months as being within the short term or medium term. And then step number 2 is to identify, based on the investment, what type of source of funding will this investment require? You will need to understand that the source of funding has to match the period of the investment also. So if the investment you're looking for is long-term, then you're more likely to actually be looking for funding that is a long-term. And if it's a short-term, then, and generally the short-term will actually be things like a revolving loan, credit card. It will be even a bank loan that is short-term. But when then you're talking about long-term, that will then now look at the instruments that are actually going to take longer, which can also include a bank loan, a bond, and asset financing, and so on. Now, the next step is to say who actually provide that type of funding and what are their requirements and what are the things that they're excluding and what are the amounts. Is that amount sufficient for me to actually be able to acquire this thing that I'm actually buying with this money? Now, generally, you also have to prepare for once you've done that, you'll do the list of funders and the checklist for each requirement. And then we will share, I think I will share the link for you guys for that little bit of a template to assist you. But just make sure in terms of clients, you have recent management accounts, you have financial statements, you have a business plan with a 5-year projections. At least also when it's less than that, make sure it's within the loan period that you're asking for. And obviously the stuff that Kate mentioned, industry compliance and tax clearance and COIDA. So the key tips there, though, is that just make sure that your business is not making losses. Because if it is, it's rather better for you to apply for a purchase order or contract financing, or go for an equity but not debt. Also, the letters of intent, I've said this earlier, that is not necessarily considered a contract. Rather, also try to see if you can get verifiable leads based on your conversion rate. And then, as I said, who provide that type of loan is very important, because not everyone will actually be providing the same type of loan based on the risk and the industry. So check if the fund actually even generally give, because there are certain industries that are actually excluded. Okay. The other part that we need to work on is really about making sure that you prepare for the process. There's 7 C's of credit assessment that they look at. They look at you as the owner or a jockey of this horse, and then they look at the horse. So make sure that you understand that credit is actually trust. Therefore, you must have a capacity and a capability to be able to deal with the debt, but you must have demonstrated that before. Collateral, control, condition, capital, and character. Character that relates to you as an individual in relation to the credit report that you actually are supposed to have when you're starting this process. Now, there are few things that you gotta need to understand and know that are generally problematic, especially for Black entrepreneurs. One, you could be blacklisted. You make sure you have a settlement agreement. If you don't know whether you are blacklisted or not, do a credit report. It is free once a year, and then start making settlement agreement. Try to even pay 100 rand towards a 3,000 rand is better than nothing, because they're just gonna say, even if it's a small amount. Make sure that you add the value of your business on your personal assets based on your percentage ownership. If you find that in your personal assets and liabilities, you actually have less assets than your liabilities, i.e. you are actually insolvent, because they're also not going to give you the money if you are. Review your accounting policies. Try to see if you can't carry your assets at the market value than at the historical cost. Review your useful life. Number 4, remove shareholders or directors that are blacklisted on your bank account signatories, because that is considered as an office of trust. If they are blacklisted and they are also signatories of the, there's a risk there. Capitalize on your intellectual property, like your systems that you're building, the customers, do a value of some sort, get a mentor. I mean, Velu was mentioning, we have SmartWise. There's so many mentors out there and they are good prices. So maybe get someone to assist you on that. Make sure though also your MOI and the shareholders agreement does not have conflicting clauses. And if you have a shareholders loan account, consider converting it to equity. And I generally say that to entrepreneurs that most of the time, I know I've reviewed so many of your financial statements. You guys have 100 rand on your share capital. Please look at your financial statements. You shouldn't have 100 rand. You should convert your loan so that it's a shareholder's contribution. Avoid having cash withdrawal at all costs on your business account. And please don't use the business account for Pick and Pay and Spot Tops unless you are actually in catering services. Ensure that there's one director dedicated on doing the funding process, and they have resolution that actually empowers them to run around, because you will need to do a lot of run around and cleaning up and preparing, and also just being on top of things so that you can respond to the funders promptly. Okay, I'm almost done, entrepreneurs. I know that we kind of, I feel like we're kind of running out of time, but we're almost done. So I mentioned earlier that you're gonna need to focus on the main areas in relation to identify the problems of your funding and the problems that, and as you are getting feedback, fix the feedback that each funder is giving, because if it's not picked by another fund, it's probably going to be picked by somebody else again. So if they are identifying problems, start working on those problems and resolving them. Here are the best resources for funding. FinFund has over 15,000 funders, and you also have the government funding, which is basically going to be DFIs, but including each province, because there is also funding at the province level. And also there's ESD funding, that's the resource. There's a specific one also on the agriculture, which was prepared by Western Cape, but you can also fund funders that are actually funding at the national level.